understand how the economy works so consumers have the tools to make sound financial decisions.
We are about to hear from Jerome
Through
Powell.
this education program, teachers have access to classroom-ready online resources for students from kindergarten to college. Videos, classroom lessons, online education, publications, and more. These resources are all free for educators to use in their lesson plans, or as they see fit. Many of the Federal Reserve System's regional reserve banks,
Make sure to hit that like button on the way in and make sure to subscribe to the channel.
Also offer in-person and
Chat,
online
let me know in
professional
the comments
development
what
that
you
allows
think Jerome
educators
Powell
to
will
deepen
do.
their knowledge
Are
and
we gonna
hone
get
their
Rick up?
craft when it comes
We
to
keeping it
economics,
real,
personal
keeping it the
finance,
same.
and more.
Let me know. Hard Hat
At the
Powell's gonna
board
give
and
us
reserve
the
banks,
business.
students
See how the
also
markets
get
react. I'll be
hands-on
here with you.
opportunities like
Let's get it.
internships and
Let's
participation
tap
on
in
student
again.
boards,
I'll see
which
you in a little
introduce them
bit.
to key
We're gonna
economics concepts
let
and
Jerome Powell
potential
just run his
careers
mouth
in economics
and
and
see what
finance.
happens. But thanks guys for tapping in. This is Coin Zone.
Consumers are empowered to make sound financial decisions through the availability of easy-to-understand resources that explain personal finance concepts, the broader economy, and the Federal Reserve's role in it. Federal Reserve Education is committed to equipping educators, educating students, and empowering consumers when it comes to understanding and participating in our evolving economy. For more information, visit federalreserveeducation.org to find links to resources and reserve bank programs offered near you.
All right, here we go, guys. Let's get ready. Ooh, Fed functions.
Hi, I'm Ian, and I work for the Federal Reserve, the central bank of the United States. The Federal Reserve System consists of three main entities that perform key functions that serve the public and promote the health of our economy and the stability of our financial system.
Great.
These key entities are the Federal Reserve Board of Governors, 12 Federal Reserve banks operating around our nation, and the Federal Open Market Committee. Based in Washington, D.C., the Board of Governors is the governing body of the Federal Reserve System. It's an agency of the federal government that reports to and is directly accountable to Congress.
Yes, sir.
The board consists of 7 members, or governors, who are nominated by the President of the United States and confirmed by the Senate. Governors are appointed for 14-year terms. The Board of Governors oversees and sets policy direction for the system, including 12 Federal Reserve banks located around the country, which take the pulse of the nation's economic health from a regional perspective.
Okay.
The 12 reserve banks represent different geographic regions, or districts, and were set up based on regional economic considerations. Although supervised by the Federal Reserve Board, the reserve banks operate independently in many respects. The reserve banks carry out a number of core system functions, such as supervising and examining commercial banks and other financial institutions, enforcing compliance with federal consumer protection and fair lending laws, while promoting local community development and lending to depository institutions to ensure crucial liquidity in the financial system. They and the board also play a key role in another primary Fed function, fostering the safety and efficiency of our nation's payment systems, including distributing currency and coin to banks, operating electronic payment systems, and clearing our checks. In addition, the reserve banks act as the government's bank, providing services such as maintaining the Treasury Department's transaction account and issuing and redeeming U.S. government securities. They also act as a bank for banks by providing key financial services to banks, thrifts, and credit unions. The reserve banks also provide a wealth of information on conditions across the nation, information that is vital to formulating a national monetary policy that helps maintain a healthy U.S. economy and a stable financial system. Okay. The board and the reserve banks together help ensure that consumer and community voices are heard at the central bank through consumer-focused outreach, research, and analysis. This helps keep the Federal Reserve's actions, policies, and decision-making attuned to what's going on in American households, communities, and businesses, which are the foundation of our economy. The third key Fed entity is the Federal Open Market Committee, or FOMC, which brings together representatives from the board and the reserve banks to consider the state of the U.S. economy and set a course for our monetary policy in a manner that seeks to promote an economy that works for all Americans. The 12-member FOMC establishes an appropriate position or stance for monetary policy to help move the economy towards 2 essential mandates set for the Fed by Congress, promoting maximum employment and price stability. This occurs mainly through the FOMC's influence on interest rates and credit conditions, which can significantly impact financial conditions, including economic productivity and even spending and investment decisions by households, communities, and businesses. Working together, these 3 key Fed entities and the unique Federal Reserve System structure established by Congress more than a century ago help promote conditions resulting in a strong, healthy, and sustainable economy. For more information on how the Fed functions, visit federalreserve.gov and click on About the Fed.
All right, here we go, fam. Thanks for the breakdown, Ian. We love you, brother. Great job. All right. And it's back to commercial time. We love to see it. All right, guys, let's enjoy the beautiful landscape. Watch live. Okay, 2:30 p.m. Eastern, FOMC press conference. So we have a little bit to go. Look at the beautiful landscape. Washington, D.C. What a beautiful place. Cleaning up the streets. All right, chat, why don't we just pull it over to this tab instead? We will go and have a little fun on X in the meantime, just to see what people are saying. What is happening with the markets? There's actually a lot of stuff that's going on today, guys. In all seriousness. What is that stuff? Well, I'll tell you. All right, first off, guys, I'm seeing a lot of XRP fans a little upset about the following here. This is Crypto Bitlord. This guy has like 400,000, 426,000. Not small potatoes. We love potatoes. Hopefully you guys are eating healthy out there. All right. So first off, guys, Solana did a deal with Western Union. The world's largest money transfer business is building exclusively on Solana. Yay, clap it up if you're a Solana holder. Phenomenal job. Great job, Solana. Anatoly Yakovenko, phenomenal job. However, this guy, Crypto Bitlord and XRP Maxi, is saying, as a major XRP stakeholder, I'm genuinely concerned. You guys worked on this for over 13 years at Brad Garlinghouse, at Chris Larson. How did this dog-ish Solana come to onboard Western Union? Isn't that why we exist? Okay, you know, I pointed at this earlier, but this is a big deal. This isn't a small deal. This one makes me laugh. Crypto Karen, Elizabeth Warren, finally getting a taste of her own medicine. Just going around saying untrue things. Yeah, well, CZ said not today, okay? Elizabeth Warren reminds me of a high school teacher who gets mad when you run in the hallways. She reminds me of someone who calls 3 or 4 kids' parents regularly just because their kids are annoying and they can't sit still, and the parents are like, ma'am, you're a sweet woman, but we have 9 to 5s. When the kid's at school, he's your priority. And Karen is just keep pushing. That is Elizabeth Warren. Chat, let me know how you feel about Elizabeth Warren in the comments. Okay, she's a sweet looking lady. Not like that. Pause. You know what I mean? She looks like she's a nice lady, but in reality, she's got claws. And she's trying to sue people. She's trying to do this. She's trying to do that. She's teaming up with the banks. A lot of shady stuff when it comes to E. Warren. All right, what else do we got today, ladies and gentlemen, before we hear from Jerome P., our favorite guy? So, AWS is down again, guys, today. You know, this is the second time this month that we have seen this. AWS be down. What is going on? Sincerely, what is going on? And this just forces you to ask questions. This time, Microsoft Azure is impacted as well, with potentially Cloudflare also being a casualty. So this is just not a good look, guys, and especially if you are a crypto company or currency and you're still reliant on AWS. You know, as someone who's worked at tech companies, etc., I've been involved with tech for a while. AWS runs a lot of infrastructure, a lot of setup for so many companies, schools, etc. This is not a small deal. So if we're having an issue now with AWS, what's the solution? Well, probably something decentralized like a cryptocurrency. So, I mean, that's just the kind of obvious thought, right? That's the evolution, right? That's why some of us are here in this space right now. Zooming back in for a little bit, all 1490 of you, 1420 of you, let's go, 420. All right. All 420 of you guys tuning in. Chief the Yorkie, brother, always tap in with us. We appreciate it. What is going on? Do you think he's going to cut the rates? I do. Yes, I think Jerome Powell is going to give us a 25 rate cut, 25%. This is Jerome Powell. What do you guys think, chat? Quote unquote chat. Should I cut rates by 25 or leave it unchanged and F the crypto bros? Yeah, I mean, realistically, though, that's basically what's happening. A lot of things I think right now are contingent on where the market's going to go. You know, we have a chart from DZ. Why don't we pull that up real quick? Chart from DZ. Shout out to DZ. Easy peasy, lemon squeeze me, BB. Okay, look. So, the last altcoin season, when did we finally get kicked into, you know, the last big run? Right? Well, there was a golden cross, which led to a death cross, which led to a second golden cross, which then led to altcoin season. So DZ is saying, look, I think this is where we're at. We're going to get a death cross soon, another golden cross, and then it's to the races. This cycle, it looks like a death cross will form over the next week or so. After that, alts should rally. All right. Well, we will see. We will be tracking it all here on the Coin Zone. Once again, guys, if you haven't subbed, that's crazy. Just in, the Fed cuts interest rates by 25 basis points as expected. So there it is, guys. Lark Davis. We will hear it officially from JP in a little bit here live. But as we always know, the Fed does it beforehand. So the Fed lowers rates by 25 basis points to 3.74%. Why don't we just go ahead and do this instead now? No reactions from the markets yet. It's only been around 10 minutes or so, but it looks like nothing really is taking place. Very interesting. So maybe we'll see afterwards when Jerome Powell gives the actual speech in around 20 minutes or so. But it's going to be interesting, guys. I think you mean 1/4%, 25. Yeah, basis points. Yeah, 25 basis points. So that's what that is of a percentage point. You are correct. But this is what's going on, guys. I mean, heading into November, it's the end of October here. You know, happy Halloween to all you spooky people out there. I haven't had a single candy bar or anything. It's been a little depressing. We'll see what happens. But at the end of the day, guys, what are we seeing? We're seeing a lot of positive bullish news here. We're also even seeing Senate Democrats are moving to condemn Trump pardon CZ. That's crazy. I mean, who knows? It is what it is. CZ is trying to come after Elizabeth Warren, blah, blah, blah. It's a lot happening, guys. Okay, here we go. Here's something interesting. So AWS and Azure are both down. Akash is up with 0 downtime after a major upgrade. Choose a decentralized cloud if you want reliability. Akash network is ready. You guys all know, if you've been following me here on the channel, I have a sudden, very, very massively big interest in the Akash network and the future of protocols like this, just because of the demand of AI and where we're headed into the future with that. It's going to be very interesting. The blockchain AI crossover and how you could potentially take advantage of, you know, where the world's heading. You know, right now, all the top data centers in the world are in the United States, and they're all, you know, there's a handful of top companies that spend the billions of dollars to build out these infrastructures and the AI models and to do this and that. The world that is controlled by all of these large entities is going in this direction. That's the way I'll say it. So it's like, why wouldn't you want to just like kind of take advantage of where the world is going and just trying to, you know, profit from that yourself and you know, not let just the big guys continue to win, but also do your research and try to win yourself. That's the way I like it. Just kidding. That's the way I look at it. But yeah, guys, we're still waiting for Jerome Powell. Okay, the FOMC. Watch live. We got 15 minutes left. Then we're going to see Hard Hat Powell say some things. The markets maybe will go crazy. Nothing's happening yet. right? Back over on Coinbase, nothing really going crazy. Bitcoin still at 111. ETH back under 4K. Wow, guys. I mean, so much for October. Am I right? People thought October was it, guys. We're going to see some crazy things. And then guess what? Nothing happened. Guess what happened? We had the biggest liquidation event in history. And I think we will find out more to come. All 432 of you guys on with me right now. Someone hit me up in the comments. What are we looking at right now? What do we think about Sui and Solana? More like Downtober. Yes. Good pun right there, brother. Chief the Yorkie. It is more like Downtober. Because look, we're looking right now. Everything's red. All I see is red. All right. Oh, there's some green. How about that? Green and red. Shout out to St. Nicholas. Christmas time is around the corner. Very good, guys. What do you guys want for Christmas? Some freaking gains, man. That's what we all want. Okay, we want Chad and the Giga Chad bull run, not the Ibiza bull run guy. We want different things here. All right. So let's get back to X. See what else is going on in the markets. Bill Gates, you guys are just looking right at my feed right now. Federal Reserve cuts interest rates by 25 basis points. Western Union CEO Devin McGranahan. We chose Solana because it's the fastest, the most efficient, stable, and secure blockchain. Yeah, that's big cap. That is not even close to being true. First of all, Sui is faster, most efficient. I mean, it goes down. And it gets hit with sandwich attacks and gets user funds stolen all the time. So efficient, that's a freaking joke. Stable, it goes down. Secure, I just said it gets hit with attacks. So I don't know where this guy got his information from, but look, I'm not trying to be biased. There are clearly many things wrong with Solana, but it just seems like no one gives a shit. Everyone is just like, great. Oh, it's faster than Bitcoin and Ethereum. Okay, great. Let's do it. Like, okay. That's the way people want to look at it. I'm kind of numb and dead inside, but my whole life is crypto, and that's not going to change anytime soon. Well, you know, I can't say I don't disagree with that sentiment. You know, I think we all expected better gains at this time and haven't gotten them, and it's been tough. It's been tough. No one ever said this was going to be easy, though. And I feel like this is one of those times where we're being tested. It's like if you leave now and then, you know, in 6 months from now, everything's up 600%. Like, are you going to be even worse off? Yeah. So I would say just stay the course. Continue to have that conviction. If you feel like you want to hop out of a play, then maybe, I mean, think about it. But you know, just make sure that you're doing an incredible amount of research first. You're not just doing anything irrationally or based off emotion. That would be my 2 cents. And we're still waiting on Jerome Powell, guys. So we'll hear from him in around 10 or 11 minutes or so. He will be announcing a rate cut change. This is going to be big news. And yeah, I mean, this is pretty crazy though. Guys, let me know what you think about this Western Union Solana situation. It's definitely going to be interesting. According to Altcoin Daily, 107 million crypto longs to be liquidated within 4 hours. Okay. Ahead of FOMC announcement. Yeah. I mean, this is crazy, guys. AWS and Azure are both down right now. 52% of the internet depends on these two companies. Both just failed simultaneously. I mean, I'll say it again. Just think about it. Think about how you can profit and benefit off of where the world is heading with AI and everything right now. All right, things are going to change. They're going to change dramatically. And it's not going to wait for you to catch up, guys. So let's just do that. All right. Adam Kobisi letter. Let's read what Adam has to say. I think he's a good Twitter account here. What does he have to say about the Fed? Today, the Fed will cut rates with the S&P 500 at a record high for the 5th time in history. In all of the 4 previous times this has happened, the S&P 500 ended higher 12 months later. The average 12-month gain is nearly 20%, fuel to the fire. So that's good news. All right. What does that mean? If this ended 20% up, I mean, crypto, what are we thinking? 100% up? And then altcoins like freaking 1,000%? I don't know. Maybe I'm being too bullish. But there is some interesting truth to this. Okay. I mean, it's just another catalyst, and I think it's bullish for the rest of the markets. In 2026, I think so many positive things are going to start happening because all of the investments that Trump has gotten done into the United States, I think a lot of the job creation, we're going to see a lot of different things happen in 2026 that I think are going to be very positive. So, I mean, we haven't even seen all the ETFs approved yet. We haven't seen a lot happen yet. So I can be a little bit more patient. And I'm very interested. I want to see what it's going to look like in 2 years from now, in 3 years from now, 4 years from now, 5 years from now. Like it's not all about getting rich now and everything like that. If you can hold on and have a lot more patience, this is a much longer term play. I'm curious to see what the world's going to look like in 2035. That's 10 years. If you can double down and make investments now and hold for 10 years, that's how you get rich. That's how you build wealth. All right, guys. So I don't know how old you are, how young you are, but just make a plan and have a well thought out longevity term, style plan here, guys. That is my 2 cents. There is a lot to look at here, guys. All right. We're still waiting for the Fed. Jerome Powell, our favorite guy. All right. Hard hat P. All right. Jerome Powell. This is what we're doing now, guys. As we wait for him to make some speeches, we will just be reminding you who we are about to hear from, which is Hard Hat Powell. Let me tell you, for the rest of Donald Trump's administration, this will forever be one of the funniest moments to me. If I could relive this day when we covered it live, I probably would. I would take the option to relive the day, to go through this experience again with you guys together, right? What a beautiful experience it was. What a beautiful experience. Yeah. If you guys don't know about this day, Hard Hat Powell, I feel bad for you. We had a lot of things happen that day, okay? And now we're hitting the gong because we are just 7 minutes away from hearing from Hard Hat Powell again. And it's going to be a good day. All right, no hard hats today. No construction being done at the Federal Reserve for this conference. So we should be good to go. Guys, continue to reach out to me in the chat here. Let me know what we think is going to happen for the rest of the year. Uptober, really Downtober, is about to come to an end. We have Moonvember, I believe is what they call it. And then who freaking knows what they say for December. I have no idea. Something with, upness, whatever. We'll see what happens, guys. All right. I don't know what's going to happen. I'm not a mind reader. But we can look at data. We can follow the markets. And we can try to do our best. And that's what we're doing here for you guys all the time. Right? You guys know this is the Coin Zone on Crypto with Paul. We're always going live, giving you guys videos, interviews, etc. As a matter of fact, whoa, do I have a treat for you? Like a dog, your little dog. Okay, guys. Sharing this tab instead because I want to let you know about our latest interview with Leo Lanza. This just came out 1 hour ago. Now, this was a really cool sit down. Leo's a really smart guy. Very, very, very knowledgeable on Ethereum. So go check this out, guys. I know you guys like our interviews a lot. Our last two at 1.3K, XRP, CRO. Now we got one ETH based right now. So go check this out, guys. This was a great interview. And my eyes got super dry throughout you know, the interview. So I had to put my nerdy ass glasses on. Okay. You guys can go make fun of my glasses. All I ask is that you just go check out the interview. It's a good time. Shout out to Leo. Go check this out, guys. And if you haven't subbed to us yet, that's crazy. That's pretty crazy, right? So once again, let me just go ahead and share this again. Now we got 5 minutes left until Jerome Powell speaks. Love to see it. Now, in the meantime, before we get situated, I will be right back because I'm going to go get some coffee. All right, I'm running low here. Gonna go get a little coffee. I'll see you guys again in 4 minutes or so when Jerome Powell pops back up and lets us know that we will be getting a rate cut. All right, chat. See you in 2 seconds. What just went flying across the screen there? Did anyone see that? All right, we got 1 minute left until Jerome Powell is giving a speech. It's the moment that you've all been waiting for. Haven Peck, bro. Phenomenal job. Congrats on the sheep buying a vehicle. Love to see it. What crypto can do for people. Chief the Yorkie saw that thing flying by. What was that? Is it a UFO? Confused. 1 minute left until Jerome Powell takes the stage, guys. We're getting rate cuts. We'll see what else the man says. Should be a good time. Make sure to like this video and share it out. Retweet it on X. Go like it on YouTube. We're getting close, guys. It looks construction related, probably. Okay, here we go. Here we go. Let's get right to it. Jerome Powell. Now I feel like I'm at a golf game. Gets up to the green. Takes his swing. Okay, here we go, guys. Is it going to be good afternoon or welcome? We'll see. What is it?
Good afternoon.
Knew it.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggest that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 3 3/4 to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet, and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
All right, JP.
Nick
On with the
Wall Street
questions.
Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that needs to be taken on board. We had, I would just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market, and suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, others people would say moderately restrictive level, needed to move more in the direction over time of neutral. if the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
Claire.
Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other, and they also have different levels of risk aversion. And some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when more participants go out and talk, they're very disparate views, and they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, that we haven't made a decision about December. I always say that it's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
That could be one of the factors, but the reality is we've seen, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars, because again, the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby.
Thank you. Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second-round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, we do have, we get some data. The labor market is a place where we get, for example, we get the state-level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings. And we'll get lots of survey data. We'll get the beige book and things like that. So we'll have a picture of what's going on in the labor market. And the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the beige book again. I would say we're not going to be able to have the detailed feel of things. But I think if there were a significant or material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's the meeting's I guess 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving, but we'll have to see how it unfolds.
Steve.
Steve Leisman, CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had two dissents, one for 50 and one for no cut. So, that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet, if you stop it, the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what, in the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be right now it's got a lot more duration than the outstanding universe of Treasury securities, and we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding Treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle Marte with Bloomberg. how are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So, okay, so the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation. But we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments. But so directionally, you know, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services, and we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be, 5 or 6 tenths, and so that, if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come, and it probably will increase further, but it is that it will be a one-time increase. And we've been very focused for all of this year at making sure that that's the case and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think, we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say that first.
The stubborn services inflation that you mentioned.
Service inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just, we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market, is because the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles. How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run, longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. Could you mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard.
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about the continued shutdown, making it more difficult to make a move in December, and that may make you more cautious.
This guy looks like Robert California.
Relying on private data that isn't the gold standard, or that you're relying on your own surveys of the Beige Book. Do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up in the debate on this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do. So we're watching that very carefully, and yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are, if you listen to the earnings calls or the reports of big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products, but that at the top, people are spending at the higher income and wealth, and so much anecdotal data on that, and so we think there's something there. So,
Edward.
Thank you. Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction in rates is not a foregone conclusion. So in December, you said far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then? Well,
the perspectives of people on the committee that, we've now moved 150 basis points, and that we're down into, you're into that range between 3 and 4 where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So, I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth, that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, again, we've cut 50 more basis points in the last 2 meetings, and there was a sense like, from some, let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views. And so on that division, then, you're talking about going forward. So what's more important in this division? Is it inflation risks? Is it employment risk? Or is there a deeper philosophy division among the board? Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have in fact cut 2 more times. And we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes. And I'm just telling you that's what happened in the meeting.
Elizabeth.
Thank you so much. Elizabeth Schulze with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are 2 things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's 2 things. That's declining labor force participation, which is a cyclical thing, and then there's declining immigration, which is just a big policy change that actually began in the last administration and it has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and so the unemployment rate has gone down, meaning that demand for workers is going down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand, and and I would just say, when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work is pretty close to zero. So maximum employment doesn't, on a sustainable basis, doesn't, if you're creating zero jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last two meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. So it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools, but others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are a tenth or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think some projections go, we're at 2.8% inflation. You might get 2 or 3 more tenths or 4 more tenths maybe. But then, as all of the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not, at least this is the theory. This is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up, if you will. Prices stop going up. They'll just be at that level, and then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Michael McKee from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close to being overvalued at this point?
We don't look at any one asset price and say, hey, that's wrong. It's not our job to do that. We look at the overall financial system, and we ask whether it's stable and whether it could withstand shocks, right? So, banks are well capitalized, while some households are clearly under stress. In the aggregate, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. You don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not. It's not appropriate. We don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI, of the data center story. I think, people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about, it's not about 25 basis points here or there. We use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here to, by lowering rates at the margin, that will support demand, and that will support more hiring. And that's why we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, I've told you the story. It's a complicated story, but this is the best assessment that we can make. Because there's uncertainty around inflation and the path ahead for inflation, that's why we're going, the pace we're going has been a careful one.
Victoria.
Hi, Victoria Guida from Politico. On AI, I'm just wondering, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different. In the sense that the companies that are so highly valued actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these were ideas rather than companies, and so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and it looks like they have business models and profits and that kind of thing. So it's really a different thing. The investment we're getting in equipment and all those things that go into creating data centers and feeding the AI, it's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, is much bigger than that, and has been growing, and has defied a lot of, negative forecasts, continuing to do so this year. Consumers are still spending. Now, it may be mostly higher end consumers, or maybe skewed that way, but the consumer is spending, and that's a big chunk of what's going on in the economy, substantially bigger than AI. You could point to growth. I mean, actually, growth as opposed to level, but consumer spending is a much bigger part of the economy.
And why do you think that the labor market is slowing so much, even though consumer spending is strong?
Why has it slowed so much? Well, what's happened is that the supply of workers has dropped very sharply due to mainly immigration, but also lower labor force participation. So, and that means there's less need for new jobs, because there isn't this flow into the pool of labor that where people need jobs, because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. The economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown. And of course that will reverse. But you still got the economy growing at a moderate pace.
Andrew.
Hey there, Andrew Ackerman with the Washington Post. I wanted to ask if you could elaborate on how you think about policy in the context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you inclined to proceed with added caution because of uncertainty?
Yeah, well, we'll know when we face that question, if we face that question. It'll probably be argued both ways, right? But I've said a couple times here that, if you really aren't getting information and you really don't know, and the economy looks like it's solid and stable and hasn't really changed, there will be an argument I don't know how persuasive it will be, but there will be an argument that you slow down when you can't see as far ahead. Others may argue, I mean, I'm not sure where this argument will come, but you're perfectly right that you could also argue, well, things haven't really changed, but you might not know that, So I don't know whether we'll face this or not. I hope we don't. I hope by the time of the December meeting we're getting, a better flow of data. But if we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a FinReg question. I think several years ago you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies, and I don't want to get ahead of those discussions. I continue to think that the level of capital when I said that in 2020 was about right. And of course, there's been much capital added since then through various mechanisms. But I look forward to I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Brian. Hi, Chairman Powell. Brian Chung with NBC News. Is the weakness in the jobs market accelerating, and who's at risk if the interest rate cuts are not the effective medicine for a further slowdown in the labor market?
So we do not see the weakness, as you put it, the weakness in the job market accelerating. I would say, and again, we didn't get the September employment report, payroll report, but we look at the unemployment insurance claims, initial claims are reported at the state level, and we still get those, and we can accumulate them and get the national number. And there's really, in no story, you can look at the numbers. Same thing with the job openings we get from Indeed. There's just no story over the last 4 weeks. It's kind of stable. So you don't see anything that says that the job market is, or really any part of the economy is making a significant deterioration. Don't see that. You see more things like I mentioned, though, which is you see big companies making announcements of either of layoffs or of the idea that they won't need to hire. Their number of employees is not expected to go up over a number of years. There may be different people working there. They say that too, but they don't need a bigger head count. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up, but job creation is very low. And the job finding rate for people who are unemployed is very low. But the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular section of the labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people, we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so, yeah, a stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job, but it is absolutely the best thing we can do for people. Along with keeping prices stable. Those two things. Inflation also hurts people on fixed incomes more than other people.
Courtney.
Hi, Chair Powell. Courtney Brown from Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. we're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
Okay, thank you.
Daniel.
Daniel Davis, Agence France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions, and you've just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings, and if so, how?
I wouldn't say that, no. I think you have to take what comes, and what comes right now is a pretty challenging situation where we have, first of all, we have 4.3% unemployment. We have an economy that's growing close to 2%. So, overall, it's a good picture. It's a good picture. But in terms of our policy, we have upside risks to inflation, downside risks to employment, and this is a very difficult thing for a central bank because, one of those calls for rates to be lower, one calls for rates to be higher. We can't do both, so we have to balance the two. And so it's a challenging thing, and as we have worked our way through this process, you would expect that there would be a range of views across the committee on what to do and the speed with which we should do it. And that's what we have. That makes a lot of sense to me. All of these people are, people who take their jobs very seriously, work very hard at this, and just want to do what's right for the American people, but they have different views on what that is. And, it's an honor to work among people who care that much. It is, but I don't feel that it's unfair or anything like that. It's a time when we're making quite difficult judgments in real time, and I believe we'll get through this. And I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts at some point, we will at some point. I think we're trying to get to the end of this cycle with the labor market in a good place and with inflation, on its way to 2% or at 2%. So that's all we're trying to do, and we're doing it under, quite challenging circumstances and doing the best we can.
We'll go to Jennifer for the last question.
Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Both regional and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO Jamie Dimon warned, when you see one cockroach, there may be more likely. I'm curious how the Fed is looking at these loan losses and if it poses risks to the financial system or the outlook for the economy. Is it a warning sign?
So, we're obviously, we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. We're looking at it carefully. We're paying close attention. I don't see at this point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions. But we're going to be monitoring this quite carefully and making sure that is the case.
And then separately, many, you yourself have said that we're in a bifurcated economy right now with high net worth individuals continuing to spend with the lower income pulling back. How much of consumer spending continuing hinges on the stock market remaining strong? In some odd way, does the market help keep the economy buoyant?
So there's some relationship there, but remember, the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically as you reach levels of stock market wealth. So, the stock market, it would affect spending if the stock market went down, but it wouldn't drop sharply unless there were quite a sharp drop in the stock market. People at the lower end of income and wealth have a much higher marginal propensity to consume of an incremental dollar of income or wealth, but they don't have the stock market wealth. So I think it's certainly a factor supporting consumption right now. But you would see it if you saw a material correction in spending. but it wouldn't be, you shouldn't think that it'll, dollar for dollar stop consumption, because that wouldn't be the case. Thanks very much.
All right, chat, we're back with the beautiful, beautiful music from the FOMC and Jerome Powell. We love it. Thank you, guys. But let's just pivot from that. Wow. All right. So over 500 of you guys on stream with us right now. Appreciate you guys for tapping in. Thank you for kicking it with us. Just going to look at a couple tweets before we end this here. So meet Kevin. Bro has a pretty big YouTube channel. Fed just said they'll roll over MBS payments into buying treasury bonds. That's not only ending QT December 1st and cutting 25 basis points, but basically buying bonds like QE days. Wholly bullish. Kabisi letter. There is a clear growing divide at the Fed. In his first such comment, Fed Chair Powell explicitly just said that there were quote unquote strongly differing views about how to proceed in December. He also just addressed this. Someone asked him that question just now before he wrapped up. How do you feel about all of these differences of opinion, etc.? It is what it is. Fed Chair Powell also said that another rate cut from December is far from sure. On top of this, for the first time today, one Fed member dissented the decision in favor of no cut, and another dissented in favor of a 50 basis point cut. It's a lot of indecision there, a lot of differences of opinion. Okay, Lark Davis, the Fed just cut rates by 25 basis points, no surprise. Mirren even pushed for 50 basis points, which shows Trump still wants more rate cuts. But the real story is the end of QT on December 1st. Yeah. Extremely bullish backdrop for risk assets. Again, the Kabisi Fed chair letter, Jesus. Fed Chair Powell, risks to inflation are tilted to the upside and risks to employment are tilted to the downside. Fancy way to say stagflation. Interesting take there. Okay, since Jerome Powell spoke, guys, $300 million have been liquidated from the crypto markets. Insane. Now we'll just end it here. Frequency of audits. The U.S. Federal Reserve versus Bitcoin. Last audit 110 years ago when it started. Last Bitcoin audit 10 minutes ago. So, some perspective. Keep that in mind. All 500 of you guys, I appreciate you for tapping in. We got some bullish news from Jerome Powell on today's announcement in the FOMC meeting. So that's how we'll end it here with a nice empowering photo of Jerome Powell. No hard hat on. But make sure you guys subscribe to the channel. If you watched this stream with us and you haven't subbed yet, go ahead and do that for me. Once again, guys, you are watching the Coin Zone, and my name is Crypto with Paul. Interact with us, sub on YouTube, follow us on X. Go watch our last video with Leo Lanza. Appreciate you guys for tapping in. That's about it. I'll see you next time.